Hello class, this is Demetrius Wilson again, Chapter 1, this is Part 2. Okay, so as you can see on direct materials, you have things that are used to make whatever product we are creating. So you have different types of wood. You have cherry, maple, oak, and mahogany, right? Because different schools, different companies want different type of desk. You have hardware, drawer handles, right? So let's say we're making drawers or furniture or something like that that needs a handle. That's also hardware. That would be direct materials as well. Now down to direct labor, workers who cut, plane, and glue wood, right? So this direct labor are people who are directly associated with the process of creating a good. Workers who fill and sand tables, and workers who also stain and finish tables. Manufacturing overhead, indirect materials, right? So this can get somewhat tricky, but not really if you pay close attention. So glue, screws, nails, sandpaper, stain, and lacquer. There are things so minuscule, so small that it would cost us more to track them. Those will fall under indirect materials. Indirect labor are factory supervisors, people who are over all the different departments, but they're not the ones actually creating the desk or the furniture. So they are indirect. They're not directly associated with the creation of the desk. And then other manufacturing costs, equipment maintenance, equipment depreciation, factory utilities, factory insurance, factory building depreciation, and factory property taxes. All right, so how are manufacturing costs presented in the financial statements? So for products not yet sold, all manufacturing costs are recorded in the inventory accounts and presented on the balance sheet, right? So they haven't been sold and they're recorded as inventory to show as a positive. When the products are sold, the related manufacturing costs are transferred to cost of goods sold on the income statement. So you have the money that you receive from selling something, but then you also have the cost of the goods sold. So the costs, what it took me to create this desk, what it took me to create this piece of furniture, right? That's the cost of goods sold. And then you have the money that it was sold for. Now, obviously, common sense lesson, your money that you receive for the desk needs to be more than what your cost of goods sold is. So what are non-manufacturing costs? So costs not related to production, right? So if you're not involved in the production of the desk, then whatever costs are associated with you are non-manufacturing costs. So classified as either selling or general and administrative. So selling, salespeople, marketing people. General and administrative would be like office manager or a human resource person. None of those individuals are involved in the creation of the desk, but they are involved in other functions that are required to either keep the company running or to sell the desk, right? Without the salespeople, how are you going to sell the desk? You can make the best desk ever and let it sit there in the warehouse for until eternity. They're also called period costs, so remember that for future reference. So here's a little diagram. Custom furniture company, 10% of selected items, see inside pages. Sale ends May 31st, special of the month, place your order here, right? So selling, that would be on the marketing side, right? Also, sales would obviously be on the selling side. So marketing, sales, things of that nature. Then on your right, you see general and administrative, right? You need human resources because if you don't have appropriate human resources, company will get sued, all kinds of different things will happen. So although they're not bringing money into the company, they're making sure that money doesn't go out of the company. So how are non-manufacturing costs presented in the financial statements? So all non-manufacturing costs are recorded as an expense on the income statement in the period they are incurred. So if I have to pay for someone in HR or pay for the salary of someone in sales or marketing, it's allocated to that specific period, right? And that's one of the reasons why they call it period costs. This is where the name period costs comes from. So summary of costs and where they are expensed, right? And this is a good, nice little grid to break it down. Manufacturing costs, also called product costs, direct materials, direct labor, and manufacturing overhead, all involved in the creation of that furniture or desk. The timing of expense, costs are expense when the goods are sold. So they're not expense until the goods are actually sold, go out the door, and then we say This is how much we spent on materials, how much we spent on labor, and how much we spent on overhead. Non-manufacturing costs, also called period costs, uh, involve selling and general administrative. We just talked about that, people in sales and marketing, and then also human resources people. The timing of expense, costs are expensed during time period incurred, right? And that's why they are called period costs. So identify how costs flow through three inventory accounts and cost of goods sold account. So what three inventory accounts are used by production companies? Raw materials, right? You have to have raw materials, especially in things like construction. Raw materials inventory is used to record the cost of materials not yet put into production. So I buy 3 tons of wood. That's raw material. It's not put into production. It's sitting over there in the corner. This is my raw materials inventory. Work in progress inventory. So now we've moved a couple steps ahead. Used to record the cost of products that are in production but not yet complete. So I made half a desk, right? That's my work in progress or work in process inventory. But the desk is not completed. So work in process is the desk that's not completed. Finished goods inventory is used to record the cost of products that are complete and ready to sell. So now they've been completed and they're ready to sell, but they have not yet been sold. So raw materials inventory, work in process inventory, and finished goods inventory. So how do production companies use the cost of goods sold account? Expense account used to account for the production cost related to the goods sold, right? The cost to produce these goods related to the goods that were actually sold and went out the door and we received money and or credit. When goods are sold, their cost is transferred from finished goods inventory to cost of goods sold, right? Because the desks are done and it's in the finished goods inventory, but it doesn't go to cost of goods sold until it's actually sold, which obviously makes sense. Cost of goods sold is presented on the income statement. So summary of accounts used to report or used to record product costs, right, and where they lie. So account name, raw materials inventory, cost of unused production materials, and it goes on the balance sheet, right, as an asset because it's still showing as okay. If you have $1,000 and you got $1,000 worth of wood, that $1,000 is the same as $1,000 worth of wood on that balance sheet. Work in process inventory, cost of incomplete products, right? So I have half a desk that goes on the balance sheet as well. I've done nothing with it. It hasn't been sold from the company as of yet. Finished goods inventory, cost of goods completed, but not yet sold, right? So we've completed them, but we haven't sold them, still on the balance sheet. Now the only change is at the bottom where it goes to cost of goods sold, right? Right there. And cost of products that are sold, and it's on the income statement as an expense. So now it's showing as an expense because we sold it, and now we know exactly how much money we received in return for it. So describe how to prepare an income statement for a manufacturing company. So what are the 3 schedules necessary to prepare an income statement for a manufacturing company? Well, we already talked about this. Schedule of raw materials placed in production, schedule of cost of goods manufactured, and schedule of cost of goods sold. So what is the inventory cost equation used to prepare each of these 3 schedules? And we'll see this on these next 3 diagrams that we have. Beginning balance, or BB, how much did I have? I had 1,000. Transfers in, that's how much I purchased, or TI. So I had 1,000. I had another 1,000 transfer in, so now I have 2,000. Ending balance, or EB, is 1,000. So let's just say my beginning balance is 1,000. Transferred in is 1,000, so I have 2,000. My ending balance was 1,000. So 2,000 minus 1,000 equals 1,000, which is my transfer out, right? So if I end up with 1,000 and I had 2,000, that means that I transferred out or I sold an additional 1,000, right? And we'll do some problems with this equation, but become very familiar with it. So here we have the schedule of raw materials placed in production. So just follow along with me and think about the premise that we just used. So raw materials beginning balance is $25,000. You add the current period raw materials, right? So we purchased $15,000 more of raw materials. So our total of raw materials available for production is 40,000. Now we minus or less the raw materials inventory ending balance because we ended up with 19,000, right? So we have 40,000 that we can use that we could put into production. 19,000 of it remain. So raw materials placed in production is obviously 21,000. That's what is going out of the door, and the balance is there. So the balance and what's been placed into production, right, combined equals what was available for production. Then we always have to subtract the indirect materials included in manufacturing overhead, right? So 21,000, that's usually not going to be that much. Minus that 3,000 is 18,000. That is your direct materials placed into production. And your homework assignment is going to be on that very concept. So then you have schedule of cost of goods manufactured, right? So work in progress beginning balance is 35,000, and then we have expenses, right? We have direct materials, which costs 18,000. We have direct labor, which costs 40,000. We have manufacturing overhead, which costs 96,000. So our total current period manufacturing cost is $154,000, right? So total cost of work in process is 189,000 because we have a beginning balance of 35 and we have all these things that add up to 189,000. So we less or we minus work in progress or work in process inventory at our ending balance. So we ended with 28,000. We had 189,000 available. Our cost of goods manufactured is 161,000. We have to have this number because we eventually need to come up with how much money we made gross, and then how much money we retain, which is going to be our net. Then we have our schedule of cost of goods sold. So finished goods inventory beginning balance is 90,000. You add the cost of goods manufactured is 161,000. Cost of goods available for sale. How much, of our goods do we have available for sale? Well, we have $251,000 worth of goods available for sale. Then we minus less finished goods inventory ending balance, right? So finished goods inventory, we ended up with 116,000. So the difference between these two is how much we sold, right? So the cost of goods sold is $135,000. And this is our income statement. So what does the income statement look like? We had $190,000 in sales, right? And this is what you really nitty gritty need to pay attention to if you're keeping the books at a company. So 100, but you have to go through all those other steps in order to get this. $190,000 in sales. Cost of goods sold was $135,000. That means our gross profit was $55,000. Now, gross, hey, that's not where it ends. All of you get paychecks, and you know that your gross amount is not what you're going to receive. So selling, we had to pay those salespeople and those marketing people $18,000. General administrative, we had to pay them $26,000. What are we left with? Operating profit of $11,000. That's our income statement. So income statement terminology in manufacturing and merchandising. So there's a difference. It's really easy for us to show examples and show you things on the manufacturing side. Merchandising is a little bit different, so there'll always be one or two examples there for you. But finished goods inventory is used by manufacturing companies. Merchandise inventory is used by merchandising companies. So some companies don't create things. Some companies buy things from other people and then they resell them at a higher price. Cost of goods manufactured is used by manufacturing companies, and net purchases is used by merchandising companies, right? So purchase something for $1,000, sell it for $2,000. And so what does a typical merchandising company income statement look like? It looks like this, right? So not that much different than a company that does manufacturing, but it's definitely different. So just so you know the terminology, even though we're mainly focusing on manufacturing because it's good examples for managerial accounting. So you have $450,000 in sales. You have cost of goods sold, which is everything added up here. So merchandise inventory, you had $350,000 worth of inventory. You added net purchases, so you purchased $260,000 more worth of inventory. Those two numbers combined is $610,000, which is your cost of goods available for sale. We can sell $610,000 worth of stuff. Less merchandise inventory ending balance. We ended with a balance of $320,000, right? So our cost of goods sold is $290,000. Our sales minus our cost of goods sold is $290,000. Our gross profit is $160,000. But then